we've all been talking about how building, researching, and creating impact in a global space has been important, and we truly should not just think about where we come from, but how global citizens of us we are. And to make that space, specifically when you talk about global finance, leading the way with Carnegie Mellon Research, award winning books, understanding, buying out companies, and whatnot, we've been joined by Dr. Allen over here to talk about not just how global finance has shaped specifically with his work in Iceland, Peru, the United States, entirely in a global finance space, but also someone who has had a great impact shaping up how we look at CFA as a test. So it's a pleasure to have you with us on this podcast, Professor, and I'd love to just straight deep dive into what we were talking previously. What does the finance space look like right now in terms of buying out companies?
Well, the finance space, in terms of buying out companies, is more difficult than it's been probably in a decade. The reason that it's been more difficult than it's been is because you have a lot of buyers and not that many sellers. And when you have a lot of buyers, what happens is that the price often gets driven up. And what we've seen is that a firm that is in the business of buyouts, they're out there looking for target companies. And the typical target company, the ideal target company, is one that has high profit margins, lots of cash flow, not much R&D, a company that's not going to have significant outflows and not that much risk. So everybody's looking for these companies, and there are a limited number of these companies. So given that there are a limited number of these companies, what happens is that all the people that are looking, they see these certain firms that have these great characteristics of generating a lot of cash flows and not having a lot of risk, etc. And they say they're interested. But what happens? That big market of buyers starts bidding up the price of these companies. And who's going to end up getting the company, the target company? It's really the buyer is going to be the firm that typically would have an overestimate of the target company's likely cash flows. So if you're a buyer and you think those cash flows are going to be higher than anybody else out there, then what you're going to do is you're going to be willing to pay more. And if you're going to be willing to pay more, now you potentially are going to become a victim of what's known as the winner's curse. So you end up paying a lot of money for this target firm, and it's based on the most optimistic estimate that anybody has, any buyer has, of the cash flows of that target. Now, what are the odds that the most optimistic assessment of the cash flows of that target firm is actually going to be a realistic estimate? The odds are going to be small. And what that means is that the buyer is typically going to run into problems. The buyer's not going to have sufficient cash flows to merit the money that they spent to buy that company. And that often leads to insolvency, it leads to distress, it leads to a lot of potential problems. So when we're looking at the world of purchases, and there are a lot of people in that business, and they're all over the world, whether they're in the United States, whether they're in Europe, whether they're in Asia, South America, they're looking to buy companies. And so it becomes incumbent on the buyers to try to figure out what those target companies really are worth. And so the process of figuring out the value, that's like one of the things that's important in going through something like the CFA program. If somebody decides that they are interested in looking at valuation and what value is, CFA is important. Or if one becomes an analyst, if one is an analyst for Citibank or Goldman Sachs or any of these large companies that are analyst firms, if you want to really make it up through the ranks, you pretty much have to be a CFA. And so the CFA is linked to valuation, it's linked to company assessment, it's linked to lots of the issues that we're going to talk about today.
Thank you for the debrief, and it's very insightful. And I like my brain is in different spectrums, thinking about different questions. But I'd like to deep dive and understand when. So let's say I am a buyer, or I want to start my own venture capital firm, or I want to work in the VC segment as an analyst, and we are trying to buy companies. Globally, or let's say you choose a target market for giving me a case study. And when we do that and we get on that funds and figure out, okay, to buy this company and sell. So I heard that someone once said that the easiest and the best way to get rich is buying and selling companies. So, first, how do I identify which company should be the right company to be bought, and then what should I do, or how should that transaction look like, so that that VC firm makes money, or I as an analyst can make money for my firm?
Well, it's a tough question. If it were easy, everybody would do it. But it really involves figuring out if you're, let's say you work for a company and you're now thinking about buying another company that would integrate with your own company. Now, what you want to look at are the synergies that are involved. And you want to see, are there synergies? If you're looking at buying target company B and you are company A, are there synergies between company A and company B? Now, one of the biggest problems in this process is identifying what those synergies are. And there's a fair amount of evidence that buyers overestimate synergies. So if you go and you talk to a CFO who is thinking about identifying a target company, and you ask that CFO about what are the likely synergies, and then the CFO tells you, well, I think they're probably 30 to $40 million a year for the next for the foreseeable future. My guess is that that could easily be an overestimate, because you often want to buy that company and you have to justify that purchase to the company's board. Well, how do you justify it? You have to show that it's going to pay off. How do you show it's going to pay off? You do that by showing the large synergies that are going to take place. So now you're estimating these synergies, and very often the synergies that you estimate don't show up. They're not there. And one of the problems of buying a company is that it's like people getting a divorce. How often do people get divorced? 50% of the time? I don't know, something like that. It's a big number.
Right.
Well, why do they get divorced? Because you're getting something that you didn't expect. The wife is getting a husband that, all of a sudden she sees something that it didn't work out, or the wife didn't work out. Well, it's like the company doesn't work out. The synergies are not there. And so if the synergies aren't there, the deal probably isn't going to work. And so problem number one is identifying synergies. So once you start to identify the synergies, that's a great step forward. Now, in one little area,
Right.
there's oftentimes an underestimate of synergies. I'll tell you what that is, what that area is. That happens because, let's say we're taking over a company,
Correct.
and now we no longer have to have that company's back office because they're going to use our back office.
Yep.
So we're going to save, let's say, $2 million a year. So very often when they estimate synergies, they say, okay, it's going to be $2 million a year, and let's use that for the next 2 years. But it's not for the next 2 years. It's forever, because those synergies, that or the back office rather, that back office is never going to be needed of the target company. The parent is always going to do that back office work. So those are synergies that very often are underestimated rather than overestimated. So what I'm saying is that most of the time synergies are overestimated, but some part of the synergies is often underestimated because they aren't considered for a long enough period. Those synergies can last for a long time, not just this year or next year. So that's one thing.
Right.
Now, another thing that you're trying to do when you're buying a company, you want to think about, is that company going to be susceptible to a lot of competition from other companies? So what you want to do is make sure that there's a sufficient size moat between what that target company has and what else is out there in the marketplace. You want to make sure that there are not a lot of companies that provide the same services that this target company has that you're thinking about buying. You want something that this target company has that others don't have. So you want to make sure that there's not going to be somebody else who's going to all of a sudden start competing with the company that you're buying. And all of a sudden, the cash flows that you thought you were going to get don't appear.
Oh,
So that becomes a massive problem. You want a company that the target company to be differentiated significantly from the marketplace. You don't want to buy a commodity firm. You don't want to buy a company that everybody else produces the same thing as this company that you're thinking about buying, because then it doesn't have much value added. You want a company that has a lot of value added. And now part of
right.
the job is to figure out how much value added is there in this target company. And that becomes a big issue in terms of the valuation process. So you want to go through, you want to estimate synergies, you want to make sure you buy a company that has a big moat. You don't want to buy a commodity company. You want
Correct.
to properly evaluate those cash flows. And then you want to know how much debt can that target company afford to take on. So if you buy that target company, you want to know, are you going to put 30% debt, 60% debt, 80% debt? What's a reasonable amount of debt on that target company?
Right.
Now, if so, what you have to do is you have to do a scenario analysis where you'll do an analysis taking a look at, let's say, you look at 80% debt. But if you look at the 80% debt assumption and you see that what's happening is that the cash flows will not cover the debt service, you know that that's going to be too much. So then you go back down and you take a look at 50% or 30%. And you can also look at what the typical debt ratio is in that industry. So you don't want to typically, if you look at the industry and you see the debt ratios in the industry, your debt ratio probably is not going to be significantly different from the debt ratio that's there. But if you try funding it, and sometimes they do, with a lot more debt than typically is funded, then there's probably going to be a problem.
Got it.
Right.
And
So
when,
those
yeah,
are those are some of the key things that one takes a look at. And I guess in terms of the purchase of a company, when you're doing the cash flows, you typically want to build a model of the target company that you're thinking about buying. So let's say you build a model and
and
now
yeah,
you forecast the cash flows. You can forecast them, let's say, pretty well for next year, the following year, maybe the following
uh,
year.
3 years.
If you start going and you start now forecasting them for I don't know, for 6, 7, 10, 15 years, you're going to be way off. There is no doubt you're going to be way off. However, the company is going to be worth something way off into the future. So what generally happens is the valuation will take place where you value it for you with specific cash flows for maybe 3 years or 4 years or 5 years, depending on how good you're able to assess those cash flows. And then after that, you make an assumption about the growth rate. Now, that growth rate assumption becomes so key because when you're valuing the company in perpetuity, that's such a big number. Let's say we have
Indeed.
we have a valuation of a company, and we're going through and doing the valuation, and now we take the present value of the first 3 years cash flow, and let's say we come up with
One
$3 billion.
million. Okay.
Okay, we come up with $3 billion. Okay, if we do that for the first few years, then from then on in perpetuity, that the rest of the cash flows in year 5, 6, 7, 10, 15, 20, 25, 30, etc., that value might be $30 million or 30. We were talking about billions.
Yeah.
30. Let's
30
say
billion.
let's say it'd be 30 billion. So it'd be 3 billion for the first few years and then 30 billion later on. But number is so dependent on one thing. And that one thing is the assumption that you're making about growth rate. A small deviation in growth rate is going to make a giant difference in the valuation that you're going to get. And so generally, most people who do this for a living,
Right.
what they do is they are very conservative in the growth rate. And they come up with a growth rate, the long-term growth rate of typically 3% or so. Because over long term, what's going to happen is there's going to be competition. And competition, even if you have a moat today, in year 15 or year 20, there's going to be competition. And so typically what you want to do is you want to make sure that you go through and you don't overestimate the value, because overestimating is like one of the worst sins a buyer can make.
And when we are going this much conservative and we are thinking on these lines, as a founder, when I know that I need to make an exit at year 5 or year 3, year 6, wherever, within this period, I want to scale the company so that a buyer comes in, buys the company, and I'm out of the case. So I've had an exit. How do I ensure that this exit should be exponential? So let's say we want to be conservative when it comes to growth rate, and you're giving me 3%. However, in a lot of cases, there are exponential curves when you just start maybe at let's let's start 1 million, like 1 million, 2 million, and suddenly you scale it to like 30 million or 45, and then you decide that maybe after this might go down, whatever might happen, this is the best point for me to exit because I'm getting a good valuation as well. So how do I ensure that the growth rate for within these 5 years, maybe year 3 should be the year for me to have exponential growth so that I can sell at a higher price? How do I calculate this, or how to think on these lines so that I can have that one curve that gives me that exponential exit as a founder?
Yes, a great question. It's a terrific question. The Let me give you an answer with an example. I have a close friend who has a. Oh, just a minute. I got there. I have a close friend who has a chain of 77 stores. Each store is the size of a Costco, which is a massive store. And all these stores are in one state of Ohio. So he's got these stores, 77 of them, and he thinks, okay, how do you go about selling the business? And how do you maximize the value? Should I hold on to the business another year, another 2 years, another 3 years? The key in terms of doing this is there's generally a projection of growth rate that the market has or a buyer has. And as long as, let's say, the buyer has a growth rate that is large and increasing, if G, the growth, if G is, let's say G is at one point 12%, and then a buyer or the marketplace sees that this company is growing, the cash flows are growing, it's going to be 15%, 18%, it's going to increase. Well, as long as it's going to increase and a buyer believes that it's going to increase, there's a value for the buyer, and the seller, he can sell it, but he's not going to get a magical increase in value, because if he'd hold on to the business, he'd still get that value because the growth rate's going to increase. Where he ends up making the most money is when the buyer realizes that, things are getting a little tougher here. The market believes that this company is going to still grow at 12, 15%. But he says, I know, based upon what I see, that the growth rate is falling off, and it looks like it's going to be 3, 4, 5% in the next few years. When there's a divergence of growth rates between what the seller knows he's got and what the buyer thinks he's going to get. So if the buyer still believes that this looks like a great business, it's going to grow really fast, that these 77 stores are going to continue their profitability, and they're even going to get more profitable over time, yet he knows that that growth is harder to get. There's more competition that's coming. He hears about more competition. He hears about more difficulty in regulation. He hears about all sorts of difficulties on the horizon. So if he believes that the growth rate is slowing, but the market or the buyers believe that that growth rate is not slowing, that becomes a key to when you want to sell to maximize your value. When the buyer believes that big value is out there and the seller believes that it's not there, that's the time to sell.
Wow, that's so specific and insightful as to this is when you know when to make that cut. Specific, it sounds like when you do crypto or day trading, you need to know that this is the point where you hit that stop loss. And this also brings me, since we're talking about trading and numbers, to your contribution in the CFA space. You've played a key role in shaping how we look at the examination right now. So, what were the thoughts while creating that? And like, it's one of the most tough examinations for anyone. Like, if someone is CFA level 1 or 2, you call them like great geniuses in the finance space. So, how did you make it so competitive and such a place wherein like the brightest minds would only be able to get that tag of CFA?
Well, what we did, we saw that there are more and more people taking the CFA exam all the time.
Yeah.
And I had a business with a partner, and we did expert testimony on major cases all over the United States. And these cases, for example, we represented the producers of the James Bond films. We did Enron, we did WorldCom, we did Adelphia, we did major cases. So if you pick up the paper and read about some case in the Wall Street Journal, there was a reasonable case that we were involved in that matter as experts. And we got to know a lot of people that were CFOs. We got to meet a lot of people who were analysts. And a lot of these people over time were taking the CFA exam. And we said, there really is a need for a set of questions on the CFA exam that people can study before they take the exam, and they can go through and they can test themselves on how well they really know this material. And so we went ahead and we took a look at old CFA exams, and we started drafting loads of questions on corporate finance, on securities, on ethics, on all sorts of things, that quantitative methods, all sorts of things that are relevant for somebody who's going to get a CFA. And we put these questions together. And so we looked at each part of the CFA exam, and we decided on 100, I think it was 100 questions for each part. And we put it together, and we made it available to anybody who was planning to take the CFA exam. So, so somebody who thought, I want to take the CFA exam, but I have no idea how well I'm going to do, and I really want to see if I've got the ability to pass this exam. We put this exam together on a kind of a CD-ROM, and people would be able to go off and buy it, and then they'd have all together. When you took 100 questions on a certain subject, another 100 questions on another subject, etc., all in finance, that they could see what the likelihood they would score well enough to pass the CFA exam. And we sold thousands of those. It became a product that was easy for people to, while they're at home in their living room, they could practice for the CFA exam.
That's really interesting. And I think that's the reason that now anyone who's getting that CFA level certification has to be really smart, good with numbers, and needs to know the ins and outs of what it takes to devise the best financial models for companies and the best audits. So, and I wish I could say that I have that brain, like your finance goal, but I hope to be better at it, like much more better, not just numbers like profit, gross margins, things like that, but definitely in-depth analysis of how these financial models work, which brings me to an interesting segment that we do. It's called 90 seconds to teach me something. So if I give you 90 seconds right now on the spot, what would you like to talk about?
Wow. Well, all right. I can talk about how you can make or lose money off of IPOs. All right.
Okay.
All right. So let me ask you. You seem like a smart person. How do you think if a company announces it's going to do an IPO, and it goes and does that IPO, are you likely to, and you have an opportunity to buy that stock on the day of its IPO, the morning that it does the IPO?
Yeah.
So it announces the IPO, it does the IPO, the IPO happens at 9:15 in the morning,
Okay.
and you are there at 9:16, and
Okay.
you can buy the company stock. Are you likely to make money, lose money, make money half the time, lose money half the time? What do you think? It's always good to ask the questioner some questions.
Right. Okay. So now I need to think because I lost some good money on one IPO once and I still regret it. However, if I've seen the company do good, like do great, and it's been in profits for, let's say, the past 3 years before releasing the IPO. So I assume that I'm gonna be in profits when I buy the shares of that company. And since I think I would like to get out fast when I feel that, like even if I'm making like 20%, 30% more on that stock, I'd probably love to sell that and get out of it.
Okay, so you're gonna buy it and hold it for a short period of time, and then you're gonna
Yes,
sell it.
right.
Okay, all right. Now let me tell you what happens in the real world. In the real world, most of the time, when people buy stock as a result of the IPO,
Yeah.
they end up losing money. Most of the time, that the rate of return associated with that IPO over the relatively near term, let's say if we take a look at the next half a year after the IPO, the rate of return is typically negative, not positive, it's negative. And now, if you want to know, does does it ever pay to buy an IPO? The answer is yes, it does. Now, I've asked a lot of people, analysts, CFOs, I've asked people who've taken the CFA exam. I ask them, can you tell me which companies or what are the characteristics of companies that actually you'd want to buy right after the IPO? And I get loads of answers. I get answers like the company's in a fast growing industry. The company is relatively small, so it has a lot of room to grow. I get answers that the CEO he had previously done another IPO. All those answers are bunk. They don't work. And the reason they don't work, like for the CFO, for the person who's done another IPO, that let's say you want to buy a company and the guy had done two other IPOs. Is this IPO going to likely do better? Not necessarily. The reason being is that the price of the IPO is going to be higher. So if if the company has a higher growth rate, the
Yeah.
price is going to be higher. If the CEO has done more IPOs, the price is going to be higher. How do you somehow figure out what characteristics there are of a company that you'd want to buy and make money?
Yep.
Well, we researched this and we came to the conclusion that there was one factor that we found that actually works. And that is usually when there's an IPO, the management team they throw in their stock
Yeah.
into the IPO, and that stock gets sold. Okay, so that's they no longer have the stock. What
Okay.
you want companies where the management holds on to most of the stock. If the management ends up with more than 90% of the stock going into the IPO and keeps that 90% of the stock, they aren't selling it, they're keeping it. They believe that the company is going to really do well. And who would know if the company is going to do well? The management would really know. So the one factor that's out there to tell you, is this a good stock to buy, is whether the people that constitute the management of the company are holding more than 90% of the equity of that company.
Wow. So, if that's the case, and since this is very insightful, I would love to understand when it comes to investing in different countries. Let's say a lot of people want to have a better portfolio when they feel that I should be investing in different parts of the world. So, first, I know there's a lot of legal stuff that you need to go through, But when it comes to understanding these dynamics of investing into different parts, like some company in Switzerland is doing great, and they want to expand in Japan, and you know that when that technology, that type happens, and that this technology goes to Japan, or if this technology travels the world, this is going to expand. So how do I decide on investing in that way when it comes to like, okay, these, I know about these companies doing some great stuff, I want to be one of the shareholders at this
See,
place.
all those reasons are deceptive. And they're deceptive because if it looks like companies that are in, let's say, country A and country B, and they have a history of working together and doing really well because they have different characteristics that blend together and work together really well. If I take a look at that, and if I see that those two kinds of companies work really well together, then the price of the deal is already going to be high. They're going to charge more for that deal. And so I'm not going to be able to benefit as a stockholder because of that. For me to benefit as a stockholder, I've got to find something that is not patently obvious to every other investor that's looking at this deal.
Wow. And how do you approach that conversation as well? With like, even if you, let's say you're not investing a heavy amount, like let's say 100K, but you're investing a smaller amount, 10K, 20K, 30K maybe, but not on a higher end. Do you think there are chances to be a great investor when you are not investing that high of an amount into globally diversified spaces? And also, like, and this is the second part of the question. Do you think when it comes to global finance, politics plays a huge part into how I should be approaching that thought process?
Well, if you're making if you were going to invest 10, 20, 30,000 or $100,000, uh, and if you want to be safe, you would invest in a nice diversified portfolio. If you want to make a fair amount of money, you wouldn't invest in a diversified portfolio. You'd invest in a relatively undiversified portfolio. I'll give you an example. We have a family game that we play in our family. And January 1st of every year, you pick a stock. Everybody picks one stock that they believe is going to do best during that year. Okay. So we have lots of people in the family. Everybody picks a stock. Who wins? Who's going to win that game? At the end of the year, December 31st, the winner is announced. It's the company that has had the highest rate of return in the market. It's always the person that invested in the riskiest company, not a safe company. It's the riskiest company. And like I bet on a Chinese auto parts company a couple years ago. Nobody ever heard of this. I found it. I saw it was really risky. And I said to myself, if I'm going to win this contest with lots of other people, I'm going to have to pick a very risky company and then be lucky. And that's what happened. I won with my Chinese auto parts company that nobody ever heard of. It was a public company and it did really well. And I always pick a really risky company. Now, if you pick a well diversified company, you're going to be safe. I'd certainly recommend, if I'm a financial advisor, I'd recommend to you to pick a diversified company, a diversified portfolio, because I think that's going to be safe for you. But if you want to make a lot of money, you're going to have to pick an undiversified, risky set of stocks. And that's a very different game plan than the safe, conservative approach that typically we would recommend to investors.
Wow. This is something really new. I've never heard someone say that if you want to play big play risky. Most of the people say if you want to play big, play it safe. But this is the best advice that if you want to play big, play it risky, super risky. So it's like a great gamble, but again, calculated because when you're making that choice, you were looking at different financials as well. It's not that, I think I like you and that's why I'm going to invest in you. Of course, I mean, so, I mean, there's a lot of math and statistics which we are not right now getting into the details about. However, I really appreciate the entire spacing of how this works. And this also brings us to a segment that we do. It's called Deep Dive. So, as of now, what is one area that you feel you'd like to deep dive and talk in depth or talk more about, which you feel people should know, specifically someone who's wanting to be a founder and have that global portfolio for themselves, like coming from a different part, doing things in different parts. What is that one thing that you would like to deep dive upon?
Well, you're talking about being a founder of a company or being a founder of a private equity firm or being a founder of some other kind of what are you a founder of? And I'll try to answer the question.
Okay, so we have to now. I know. So I think founder of a company.
Okay. Um, well, if you're a founder of a company, I think what you end up wanting to do is the big thing that you were after is creating a moat. When we talked about before, you want to be different from everybody else that's out there in your space. You want to create a moat. If you create a moat, you can generate excess returns. You can charge higher prices. So, for example, companies that are out there selling data, there are some people that have data that nobody else has. They charge a fortune for that data. The amount of money that I spend and my company spends on data is outrageous. Why? Because nobody else has it and they know we need it. And so we pay a lot of money. So if I'm out there buying a company or thinking about being a founder, I want to be a founder and I want to establish a moat. I want to be different than the other companies in that space. I want to price my product appropriately for that moat. And I want to make sure that I can capture the cash flows that potentially are out there. I don't want to charge like it's a commodity. I don't want to charge a low price if I've got something that's not a commodity. And I want to be able to capture I want to capture that space before I have a lot of competition. So I want to build the business up fast enough so I'm able to take advantage of that market space. I don't want to go slowly. I want to go quickly.
Thank,
Competition will always arise. I just want to make sure that I'm out there before everybody else gets into that market.
thank you so much for sharing this. This is really insightful, and I mean, when you think about it, speed and action are two best answers to the entire conversation as well. So the more you think, you get lost in loops, but the more you act is the more moat, and stable or mobilized moat is something that you get out of it, if I'm not
Yeah,
wrong.
yeah.
This has been an insightful space for me, and I've loved learning so many things. I wish we could like spend hours deep diving into statistics and solving case studies, and we hope we get another session or another hour office hour for that. It was a pleasure learning different things and perspective on how global finance works and how one needs to be so thoughtful when it comes to different aspects of finance, because it's not just about numbers but perspective as well. So thank you so much for this, Professor.
Well, it was delightful listening to your questions. I think you did a great job. Yeah. Hope people enjoyed listening to it.
Thank you.
Thank you.